This wasn't a breakout driven by enthusiasm. It was a loss of control becoming visible. In the next few minutes, I'll show you three things: what changed beneath the silver market, why that change happened without a public announcement, and what it now forces across paper positioning. The public story frames this move as momentum and speculative flow. The private move sits in settlement behavior, delivery enforcement, and a narrowing set of choices for participants who depended on paper flexibility. That distinction matters because price can rise for many reasons, but structure only shifts for one: constraint. That detail changes the interpretation. What most people see is a number on a screen, 94. What they don't see is the sequence that made that number unavoidable. Headlines focus on excitement, comparisons, and narratives about demand. What actually mattered was the quiet convergence of paper claims into a settlement window that could no longer be diffused. This wasn't enthusiasm overwhelming sellers. It was obligations colliding with limits. The public framing talks about a rally. The private reality is that delivery pressure crossed a threshold. That detail changes the interpretation. The lever here is enforcement. Not a new rule, not a rewritten clause, but a tighter application of existing settlement mechanics. Futures markets operate on the assumption that most exposure resolves without metal changing hands. That assumption holds only as long as delivery requests stay scattered and inventories remain comfortably above minimums. When delivery requests cluster and registered stocks thin, enforcement replaces discretion. Contracts stop behaving like abstract exposure and start behaving like claims. This is not philosophy. It is how clearing works when buffers are consumed. First, delivery requests began to rise relative to open interest, compressing optionality across positions that expected to roll. Then, counterparties that usually absorbed those rolls demanded more margin, more concessions, or simply declined. Next, inventory classifications that were once academic became operational constraints as registered metal fell closer to deliverable minimums. But that's not the real pressure point. After that, time itself became a cost. Settlement windows stopped being neutral and started imposing decisions. Then, liquidity that once masked imbalance stepped back, widening spreads without drama. Here's where the incentives show up. And finally, paper shorts faced a narrowing set of exits that did not include cheap deferral. And that's the hinge point. Who benefits from this shift is straightforward. Holders of physical inventory gain leverage through certainty, not through prediction. They can meet obligations others cannot. Who gets boxed in is just as clear. Participants whose strategies depend on perpetual rolling, cheap margin, and deep intermediation find those assumptions invalidated. What gets hidden is the extent to which price stability during the transition conceals stress rather than disproves it. Calm prices do not mean calm mechanics. What this breaks next follows a simple logic. If delivery enforcement persists, then paper liquidity becomes conditional rather than assumed. If paper liquidity becomes conditional, then leverage is repriced across the system, not by announcement, but by participation. If leverage is repriced while inventories remain tight, then price stops leading behavior and starts following it. Those are not predictions. They are consequences of the same mechanism continuing to operate. For viewers translating this into their own position, the implications differ by exposure. If you hold cash, stability is not safety. It is delay. The repricing of constraints tends to arrive after the calm. If you hold risk assets, correlations that felt reliable weaken as settlement mechanics override narratives. If you rely on a paycheck, the transmission is indirect, arriving through tighter credit and slower adjustment rather than a single shock. There are 5 behavioral rules that matter in this phase. Don't chase vertical moves that arrive after enforcement has already tightened. Track delivery ratios and registered inventory weekly because those lead price. Assume price lags reality when settlement pressure rises. Treat access and settlement behavior as the signal, not headlines. Keep optionality, because systems under constraint punish rigidity. The unanswered file now is not whether silver can trade higher. That question is already answered by the mechanics. The open question is how long enforcement remains the governing force before participation fully adjusts and a new equilibrium forms. When that answer becomes clear, it will not arrive with a headline. It will arrive quietly, through absence, fewer offers, tighter terms, and a market that looks confident while operating under stress. What comes next unfolds not as a celebration, but as a reordering of behavior. Once a market demonstrates that paper exposure can no longer be endlessly deferred, every participant recalibrates, even if they don't say so out loud. The language shifts first. Desks stop talking about upside targets and start talking about coverage. Meetings stop focusing on return and start focusing on continuity. That transition rarely shows up in public commentary, but it governs how capital moves. It is the second-order effect of enforcement, and it is where the real momentum forms. The public narrative around silver at 94 focuses on demand stories because those are familiar and comfortable. Industrial usage, monetary hedging, rotation trades. These explanations are tidy. They make the move feel organic. What they obscure is the structural asymmetry now embedded in the market. Paper shorts are not simply facing higher prices. They are facing fewer exits. When exits narrow, behavior changes faster than sentiment. That distinction explains why price acceleration can coexist with thinning liquidity. The market is not becoming more confident. It is becoming more constrained. This is where the idea of the paper short stops being theoretical. A short position assumes two things: that you can borrow indefinitely and that you can buy back later under orderly conditions. Enforcement pressure attacks both assumptions simultaneously. Borrowing becomes conditional as margin sensitivity rises. Buying back becomes urgent as delivery risk approaches. The combination turns what was once a strategy into a liability. Not because the thesis failed, but because the structure did. There is a tendency to frame this as capitulation, but that word implies emotion. What is happening here is mechanical. When enough contracts converge on settlement, clearing systems stop optimizing for convenience and start optimizing for integrity. That means protecting the system rather than individual strategies. From that moment forward, the burden shifts. Participants who relied on flexibility must now prove solvency, access, and timing. Those who already hold the asset are no longer required to prove anything. That asymmetry is why trends persist after they become obvious. Another layer of this shift appears in how time is priced. In a flexible market, time is abundant. You can wait out volatility, you can extend exposure, you can defer decisions. Under enforcement, time becomes scarce. Every settlement window carries consequence. Every delay has a cost. This compresses behavior. Decisions that might have unfolded over quarters now unfold over days. That compression is often mistaken for excitement. It is not. It is necessity expressing itself. As this compression takes hold, the market's internal signals change. Volume declines even as price rises. This confuses observers who expect confirmation through participation. In reality, declining volume during a rise often signals exhaustion on the sell side, not weakness on the buy side. Fewer sellers, not more buyers, is what drives the final stages of repricing under constraint. That is why the move feels unstoppable without feeling euphoric. The absence of supply matters more than the presence of demand. This is also where comparisons to prior cycles become misleading. Historical analogies assume similar structures. They assume similar inventories, similar settlement rules, similar leverage. When those inputs differ, the outcomes diverge. The current environment is defined by thin buffers and concentrated obligations. That makes the system less forgiving. Moves extend further because resistance thins faster. Reversals, when they occur, are sharper because positioning is tighter. Both outcomes are symptoms of the same condition: reduced elasticity. For institutions, this forces a strategic choice. You either reduce exposure proactively or accept the risk of enforced resolution. Neither option is attractive, but one is survivable. Reducing exposure means realizing losses or missing further upside. Accepting enforced resolution means gambling on access you do not control. That is not a market decision. It is a balance sheet decision. And balance sheets tend to choose certainty over optimism when forced. For observers, the temptation is to extrapolate. 94 becomes a stepping stone to round numbers, psychological magnets, linear projections. That instinct is understandable but incomplete. Price alone does not describe risk. In fact, price often distracts from it. The more important variable now is how the system treats positions at the margin. Are they accommodated or constrained? Everything else flows from that answer. The deeper implication is that the silver market is no longer setting price purely through exchange between willing buyers and sellers. It is increasingly setting price through the management of obligations. That is a subtle but profound shift. Markets built on exchange are governed by preference. Markets built on obligation are governed by capacity. Capacity is finite. Preference is not. When capacity becomes the limiter, repricing accelerates until the system can breathe again. This does not mean straight lines. Enforcement-driven markets are volatile because every adjustment exposes stress somewhere else. Pulling one lever tightens another. Releasing pressure in one area builds it in another. That is why sharp intraday moves coexist with strong trends. The system is redistributing risk, not eliminating it. Participants who mistake volatility for reversal often exit at the wrong time because they are reacting to noise rather than structure. Another consequence of this phase is informational lag. Traditional indicators update slowly. Official reports trail reality. By the time consensus acknowledges stress, the market has already adjusted. This creates a gap between understanding and positioning. Those who track mechanics act earlier. Those who track narratives act later. The gap widens during transitions like this, and it is where most mispricing occurs. For anyone trying to understand why the paper short framework is breaking down, the answer is not moral or ideological. It is logistical. Paper claims multiply faster than physical capacity. That imbalance can persist only as long as claims remain abstract. Once they begin to demand fulfillment, the multiplication stops. The system must reconcile quantity with reality. That reconciliation is what you are watching unfold. As this reconciliation progresses, the role of confidence diminishes. Confidence matters when systems are elastic. It matters less when systems are constrained. At that point, trust is replaced by verification. Can delivery be met? Can settlement clear? Can obligations be honored on time? These questions replace optimism. Markets that reach this stage do not reverse easily because reversing requires rebuilding slack. Slack takes time. The final takeaway of this phase is restraint. Not fear, not exuberance, but restraint. Participants who survive structural shifts are those who respect constraints without trying to outguess them. They avoid leverage that depends on timing. They avoid strategies that assume cooperation from the system. They focus on positions that do not require permission to exist. This is why the phrase unstoppable is often misunderstood. It does not mean uninterrupted. It means governed by forces that do not respond to persuasion. Once enforcement and capacity become the drivers, outcomes follow logic rather than opinion. The path may twist, but the direction holds until the underlying constraints change. That is where the market stands now, not at the end of a story, but in the middle of a reordering. The price reflects that reordering imperfectly, but the behavior reflects it precisely. Those watching only the number will argue about valuation. Those watching the structure will recognize a system adjusting to limits it can no longer ignore. What ultimately decides how this phase resolves is not enthusiasm or disbelief, but accommodation. Markets under constraint test participants repeatedly until behavior aligns with capacity. That process is slow, uneven, and often uncomfortable. It does not reward speed. It rewards endurance. The most persistent mistake at this stage is assuming that because the trend is intact, timing no longer matters. In reality, timing matters more, not less, because the system has less room to absorb error. As enforcement becomes normalized, the first adaptation is defensive. Institutions reduce exposure not because they believe the move is over, but because they cannot afford to be wrong about access. This distinction is critical. Reducing exposure is not a vote against higher prices. It is a vote for survivability. When capital prioritizes survival, it behaves differently. It shortens horizons. It prefers certainty to efficiency. It tolerates opportunity cost to avoid existential risk. This is why attempts to measure conviction through price alone become misleading. Conviction expresses itself through willingness to hold through uncertainty. Under constraint, uncertainty is not symmetrical. Upside uncertainty is tolerable. Downside uncertainty tied to settlement is not. That asymmetry drives behavior quietly, but decisively. Positions that rely on timing and leverage are pared back first. Positions that rely on ownership persist. Another subtle shift appears in how information is processed. During expansionary phases, markets reward interpretation. Analysts debate narratives, models compete, opinions matter. Under constraint, markets reward verification. Is inventory available? Are obligations met? Are settlement terms honored without exception? These are binary questions. They do not respond to persuasion, they respond to capacity. When verification replaces interpretation, the range of acceptable strategies narrows. This narrowing has consequences for volatility. Volatility increases not because participants are emotional, but because elasticity is gone. In elastic systems, shocks are absorbed. In inelastic systems, shocks propagate. A small adjustment in one area forces larger adjustments elsewhere. This is why intraday moves become exaggerated even as longer-term direction remains intact. The system is redistributing pressure across fewer channels. It is tempting to interpret these swings as manipulation or intent. That framing misses the underlying driver. What looks like aggression is often defense. What looks like opportunism is often necessity. When liquidity thins, every action carries more weight. When margin sensitivity rises, every move matters more. Participants respond accordingly. The result is a market that feels sharper, less forgiving, and less patient. At this point, the difference between owning and renting exposure becomes decisive. Renting exposure assumes continuous access to the market on predictable terms. Owning exposure does not. Ownership can wait. Rental must renew. Under enforcement, renewals become conditional. Terms change. Costs rise. Some renewals are denied. This is not ideology. It is the practical outcome of limited capacity meeting accumulated claims. This distinction explains why the concept of the paper short reaches its limit here. A short position is a rental of negative exposure. It requires continuous cooperation from the system. When cooperation becomes conditional, the position inherits systemic risk, not market risk. System risk, that is a different category. Market risk can be hedged. System risk cannot. It must be avoided. As this realization spreads, behavior shifts again. Participation narrows further. The market becomes quieter. Fewer voices, fewer trades, tighter ranges punctuated by sudden moves. To casual observers, this can look like consolidation. In reality, it is compression. Compression resolves not through argument, but through release. The direction of release is dictated by where capacity is tightest. One of the hardest aspects of this phase for participants is resisting narrative comfort. Stories about unstoppable demand or inevitable collapse both offer psychological relief. They simplify decision-making. They reduce ambiguity. The reality is more demanding. It requires holding two truths at once, that the structural direction is intact and that the path is unstable. Managing that tension is what separates durable positioning from reactive behavior. This is where historical memory becomes useful, not for prediction, but for discipline. Every market that transitions from elasticity to constraint follows a similar behavioral arc. Early disbelief, then recognition, then adaptation, then normalization. The mistake is assuming normalization means resolution. Normalization means acceptance. Acceptance locks in new behavior. New behavior defines the next equilibrium. As normalization takes hold, the system begins to police itself. Risk committees formalize what was previously discretionary. Margin frameworks codify what was previously flexible. Settlement tolerances tighten permanently. These changes rarely reverse quickly because they are justified internally as prudence. Even if conditions improve, rules loosen slowly. Memory persists. For participants trying to navigate this environment, the most valuable asset is optionality. Optionality is the ability to wait without penalty. Leverage destroys optionality. Deadlines destroy optionality. Obligations destroy optionality. Ownership preserves it. This is why, under constraint, the market quietly favors those who can sit still over those who must act. This does not mean inactivity. It means selectivity. Decisions are fewer but more deliberate. Exposure is concentrated where it does not require constant defense. Risk is taken where it can be absorbed without forced response. This approach often underperforms during euphoric phases and outperforms during structural transitions. The current phase is the latter. Another important adaptation is psychological. As price levels move beyond historical reference points, anchoring loses usefulness. Old benchmarks stop providing guidance. Participants who cling to them experience dissonance. Those who release them focus instead on mechanics. How is settlement behaving? Where is inventory moving? What is being rationed? These questions replace how high with how tight. The longer enforcement remains the governing force, the more this mindset spreads. New participants enter with different expectations. They do not assume abundance. They assume constraint. Their behavior reinforces the environment they expect. This feedback loop is how regimes entrench themselves. It does not require agreement. It requires consistency. At some point, the market will find a temporary balance. Prices will pause. Volatility will compress briefly. Commentators will declare stability. This is not the end of the process. It is a waypoint. Balance under constraint is fragile because it depends on continued discipline. Any relaxation reintroduces stress. Any influx of speculative leverage tests the system again. The final stage of this paragraph is acceptance of uncertainty. Not uncertainty about direction, but uncertainty about timing and expression. Structural shifts do not offer clean narratives, they offer messy transitions. Those transitions reward preparation over prediction, they reward patience over precision. If there is one principle that governs this phase, it is this: systems reveal their priorities under pressure. The priority now is integrity of settlement, not convenience of participation. Everything else is secondary, understanding that hierarchy clarifies behavior that otherwise appears contradictory. This is why the notion of an unstoppable move should be interpreted carefully. It does not mean linear progress. It means resistance has shifted from sellers to systems. When systems are the limiter, outcomes are governed by capacity, not persuasion. Capacity changes slowly. Until it does, the path remains defined by constraint. The market has entered a period where adaptation matters more than conviction. Those who adapt will remain positioned. Those who insist on old assumptions will be forced to adapt later, often at worse terms. This is not punishment, it is alignment. What comes after this phase will depend on whether capacity expands or claims contract. Either outcome restores elasticity. Until then, the environment remains one of managed stress, not crisis, not calm management. Understanding that nuance is the difference between reacting to noise and responding to structure. The number on the screen will continue to move. The real story will continue to unfold elsewhere. Those watching closely will notice the same thing repeating in different forms: fewer choices, tighter terms, and a market that no longer tolerates assumptions it once did. That is the condition now. Not temporary excitement, not permanent resolution, but an enforced adjustment to limits that were always there and are now being acknowledged. What remains at the end of this sequence is not a prediction, but a condition. The market has revealed what it will tolerate and what it will not. It will tolerate volatility. It will tolerate disagreement. It will not tolerate imbalance without consequence. That distinction defines the environment going forward. When systems move from flexibility to enforcement, participants do not need to agree with the outcome for it to persist. They only need to adjust to it. That adjustment is already visible. It shows up in reduced leverage, in tighter settlement behavior, and in a growing preference for positions that do not depend on permission. These are not temporary reactions. They are structural responses. This is why waiting for a dramatic signal often leads to missed understanding. The signal already arrived. It arrived quietly, through mechanics rather than messaging. The system did not announce that paper shorts were finished. It simply stopped accommodating them. That is how regimes end in practice. From here, the market does not require belief to continue operating under constraint. It only requires consistency. As long as delivery remains enforceable and capacity remains finite, behavior will continue to align around those facts. Price will fluctuate, narratives will shift, but the hierarchy of priorities will remain intact until the underlying conditions change. The mistake now would be to assume that resolution equals comfort. Resolution means acceptance. Acceptance locks in new rules of engagement. Those rules favor patience, optionality, and respect for limits. They punish urgency, leverage, and assumptions of abundance. This is not the conclusion of a story. It is the closing of a chapter. The next chapter will be written by how the system manages its constraints, not by how loudly participants argue about value. Until capacity expands or obligations contract, the adjustment continues. That is the final frame. Not excitement, not fear, alignment. And once alignment takes hold, the market moves forward on its own terms.